So now first, buyback of shares. When we say buyback of shares here, we refer to buyback of equity shares. So what does the term buyback mean? Buyback means cancellation. So when we say buyback of equity shares, company is in a mood to do what now? They are in a mood to cancel equity shares. So if at all company wants to cancel equity shares, what are the things you need to keep in mind, or how and all accounting will change is the essence of this particular topic. Can we run through? Okay, first, so buyback has certain provisions. These provisions are as per Companies Act of 2013. These are not accounting standards. These are Companies Act provision. What Companies Act says is, if any company wants to do buyback, the shares must be fully paid up. Somewhere it must be there. No, here. The shares must be fully paid up. Fully paid up means it should have reached face value mark. So only such preference shares or only such equity shares can be cancelled. That is one. And buyback should be authorized, or it should be mentioned in the articles of association. Article should give the power to the company or to its directors to do this particular buyback. And obviously buyback requires a resolution, the decision that, sir, once you pass a resolution or a decision to do the buyback, buyback has to be completed within 12 months from the resolution date, because generally we say resolution validity is only 1 year or 12 months. That's the reason. And once you do the buyback, so you're cancelling equity shares. No? Earlier you had physical shares. Now company has bought back means who had the shares before? Equity shareholder. After buyback, the shares will come to whose hands? Company ka hands. So can company keep it in their wardrobe? No, they have to physically destroy within 7 days. Once you do the buyback, within 7 days of buyback, the shares must be physically destroyed. That is one. Okay, Saru. Alright. So how much can you buy back, sir? For that there is a rule, but before that, up to 10% of buyback if company wants to do, board resolution is good enough. Beyond 10% if they want to do the buyback, up to 25%. Up to 10%, board resolution is good enough. Beyond 10%, but up to only 25%, you need a special resolution. Board resolution means board of directors, if they agree, good enough. Special resolution means 3/4 majority. And shareholders whose voting power is, who own 75% of equity shares, should say yes to this particular buyback. Only then you can go through with this buyback, otherwise you cannot. Okay, that is your provision. It may come as a MCQ question I'm giving you. Most probably MCQs I'm expecting as a case-based MCQ. They'll give you a case, some will be calculation, one or two may be straightforward. Majority I feel is going to be case-based. You don't have to do any extra preparation for MCQ. I'm getting a lot of queries on where to practice, how to do and all that stuff. MCQs will be around your concepts only. I'll take you through some MCQ questions also later on when the particular chapter comes. In this chapter only probably it will come. Okay, it will be mostly based case studies, so don't worry about extra books or extra practice and all. Revise your concepts. Using that concept only, they will build MCQ. Don't get carried away by someone marketing there, my test series and my MCQs and all that. Sir, I can form, if you give me 1 day's time, I will go form 1000 MCQs and give you. Maybe 1000 is too much, I don't have so much time. Maybe 100 MCQ question. Sir, what is one question? No, I'll only form a question. Only fully paid up shares can be bought back. True or false? For 25%, a company wants to cancel 20% shares. Do you want to pass special resolution or board resolution? Like this, using this concept only, you can construct 5 MCQ questions. Now you think about it. If I make 10 questions around this, is it really worth solving all the 10, or knowing provision is good enough? Knowing provision is good enough. So don't waste your time going behind that book or MCQ book, and not required. Just practice more towards the things that you are aware of. Within that only MCQs will come. 1 or 2 may be bouncer, I'm not denying that. But for 1 or 2 marks, we should not break our head. Okay, concentrate more towards your strengths. That will help you. Moving on to the next. Sir, there is a limit for buyback, or there is a maximum amount which a company can buy back. One is there are 3 limits. Share test, or number of shares outstanding test. We used to call it a share outstanding test. Resource test. Debt equity test we used to call it. So what does the first test says is, how much our company existing number of shares is there, maximum company can buy 25%. If company has, let's say, 1 lakh shares, company can cancel only 1 lakh at 25%, which is 25,000 number of shares. So how many ever shares you have? Only 25% of that number of shares a company can cancel, buyback. That is the first limit. Second limit is resource test. What does resource test say? Company can buy back up to a maximum limit. Sir, all these are what? Minimum limit. These are all maximum limit. If company wants to do lesser buyback, acceptable. But maximum they can do buyback only to this extent and not more. So resource test says what? 25% company can cancel. Up of what? 25% of paid up capital plus free reserve plus securities premium. Calculate 25% of paid up capital, free reserves and securities premium. Whatever value you get, that is the maximum, not number, that is the maximum value of buyback a company can do. Because paid up capital and all will be in number or will it be in value. So when you multiply 25%, you will not get number of shares. You will get the value of shares. Take that value and they will give you buyback price in the problem, 20 rupees, 30 rupees or whatever. So this value divided by buyback price will give you maximum number of shares a company can buy back as per limit number 2, which we call it as resource test. Okay, Saru. Third one is debt equity test. This is the most important one. But the question there is, it's not debt equity test. It is a debt equity. What the third limit says is debt equity ratio should not exceed 2. Debt equity ratio should not exceed 2. Okay. But what the problem there is, they say debt equity ratio post buyback, meaning after buyback, debt equity ratio should not exceed 2, meaning debt divided by equity should be maximum of 2. Meaning you can have a debt of what, sir? 2 times of equity. Or in a way, if you want, debt equity will be what, sir? Half of debt. Like this. The maximum debt a company can have is 2 times of equity, or maximum equity can company have is lesser than, I mean, you can structure this equation this way. Okay, Saru? Alright, this is the limit. But the problem there is this equation is not before buyback, it is after buyback. Keep that in mind. That will create some problems for us when we do some questions. Okay, this one. This is the 3 limits. So you will do 3 limits and then what, sir? Calculate under all these 3 limits, whichever is the lowest number. Lower among these 3 is the one that the company can maximum buy back. Okay, so all the 3 you need to calculate and take the lowest number to find out the maximum amount of buyback. This is one such question that can popularly come from this particular topic. We'll apply this also in questions. Okay. Sir, companies buying back equity shares means is the share capital same or it will reduce? Share capital will reduce because company is buying back equity shares. And this equity shares only company is calling it as equity share capital. When you cancel equity share capital, obviously its balance will reduce. Whenever capital reduces, doesn't matter whether it is equity share capital reducing or preference share capital reducing, Companies Act comes into picture and say you have to create one reserve, and that reserve is capital redemption reserve. So CRR is created with to fill what gap, sir? Capital gap. If capital is reduced by 3 lakh, then you need to create CRR to the extent of 3 lakh rupees. How much ever gap is remaining, that much gap still you need to fill it up. One way to fill up gap is by issuing new shares. Or if you are not issuing new shares, let's say you are only cancelling equity shares, you did not issue any new shares. That means capital reduced, that gap has to be compulsorily filled up by creating something called CRR, Capital Redemption Reserve. Okay, and this is what I used to give it in our class notes. CRR is created to fill capital gap, or how much ever free reserve you are utilizing to create CRR. To that extent you create CRR is what I used to say. This one I have dictated in your class notes also, correct? No, same thing. Okay, sir, if you have any premium on buyback or if you have any premium on new issue of preference shares, you ignore it. For what purpose? CRR purpose. Sir, as far as CRR is concerned, it fills only what gap? Capital gap. Capital is shown at premium value or only at face value. So if you, let's say face value of equity share is 100 rupees, but buyback price is, let's say 120. That means how much extra you are giving to equity shareholders? 20 rupees. Will you consider this 20 for CRR purpose? Nah. CRR is created only to fill capital gap, and capital is always shown at what value? Face value. Hence, premium on buyback is always ignored for CRR purpose. That way, if any new shares are issued at premium, means where will that premium go to? Security premium account. So securities premium, again, it will not affect CRR. Okay, that's the reason we say this is not tested now. Long back they used to test this. Now I don't see this particular adjustment tested, but it could come. We never know. That's the reason written it. Okay, Saru. All right. Next, sir, buyback entries we will go through. So what is a buyback entry? Think logically. Equity share capital same or reduced? Equity share capital has what balance? Credit balance. How do you reduce it? Debit. So the journal entry for buyback is equity share capital account debit. Let's say that is 1 lakh. I've assumed. Sir, equity share capital will always be debited at what value? Equity share capital is shown at face value. So cancellation also will happen at face value itself. So equity share capital account debit 1 lakh, I've assumed, which is a face value. 2, just because equity share ka face value is 1 lakh, should we have to pay equity shareholders 1 lakh only, or we could pay more? We could pay more because cancellation is a negotiation, sir. Between what? Equity shareholders and company. Company told we'll buy your shares worth 1 lakh. Shareholders told my shares is already worth 1 lakh. Company told that much only I will give. Shareholders told to hell with you, I will not give my shares. Then can company do the buyback? No. Now the company told, okay, don't feel bad. I will give you 1,50,000. I'll give you 1,50,000. Face value of the share is 1 lakh. But company is giving 1,50,000. How much extra? 50,000. That extra means for company it is a profit or loss? Loss. That loss shouldn't have a name, no? Here we call that as what, sir? Premium on buyback. Premium on buyback means over and above the face value. If company is giving any payment means that we call it as premium on buyback. Okay. So here I've assumed the premium on buyback to be 20,000. It could be anything. Is that okay? That means totally how much you need to pay the equity shareholders now? 1 lakh towards face value, 20,000 towards premium. So totally you need to pay 1,20,000. So you'll write to equity share buyback account. Earlier they used to write to equity shareholders account because you have to pay this money to whom? Equity shareholders. But our study material don't use as equity shareholders. They use the term equity share buyback. So I also changed and brought it this way. Okay. So the entry is basically capital account, you'll debit. Equity share capital account, debit. Premium buyback, debit. To equity share buyback account. Okay, sir. Sir, premium on buyback is a loss. What will you do for that loss? Transfer it to P&L. But hang on. You have something called securities premium, which is backed by section 55. And what does section 55 of Companies Act 2013 says? If you have any, if you are doing any buyback and if you are getting any premium on buyback, instead of transferring that loss to P&L first, you can set off the loss with securities premium. And security premium has only 5 uses. And P&L has limited uses or unlimited. Unlimited. Now you tell me this premium on buyback, first you will transfer with to P&L or first with securities premium? If company has securities premium, first priority to transfer this loss or to set off this loss will be with the securities premium. So what is the journal entry to transfer this premium with to securities premium account? Premium you have debited here. You are setting it off with securities premium means what will be the entry? Security premium account debit to premium on buyback. So company does not have security premium. Then what to do? Transfer it either to free reserve like general reserve or P&L. Free reserve means those reserves which are freely available for dividend declaration. Those reserves from which you can pay the dividend, we call it as free reserve. If security premium is not there, you can utilize the free reserve of general reserve or P&L like this. Or instead of 2 entries directly, instead of premium and buyback, here only you can debit securities premium. That approach is also acceptable. Okay. Fair enough, people, like that also you can do. That is one. Sir, here you have cancelled equity share capital worth how much? 1 lakh. That means share capital reduced by 1 lakh. Whenever share capital reduces, that means there is a gap in capital to the extent of 1 lakh. This gap, can we keep it or we need to fill it up? Fill it up. How do we fill it up? By creating one reserve called CRR, Capital Redemption Reserve. And CRR is always created from free reserve. And free reserve being general reserve or P&L. Our study material first uses general reserve, then they use P&L, but both are any which way free reserve. In my view, you can do whatever. Or you can stick to study material and say first utilize what's the general reserve. To create CRR, first you use general reserve and then you use P&L. So what is the journal entry for CRR? Can you tell me? Due to this, this free reserve balance will reduce. CRR balance will increase. So reserve has credit balance. How do you reduce it? Debit it. Which reserve is reducing? General reserve or P&L? Which reserve is increasing? CRR. So what is the entry for CRR creation? General reserve or P&L account debit to CRR. There was a capital gap of 1 lakh. Hence we created CRR also to the extent of 1 lakh. Last entry is the payment entry. Which how much we are calling it as equity shareholders account or we are calling it as equity share buyback. This is a liability. When this liability is settled, what will be the entry? Liability account debit to bank account. What is the name of the liability we are calling? Equity share buyback. So we'll write equity share buyback account debit to bank account. Okay, that's all is the entry. Along with this, some extra fitting may come like we have sold investment to, we have sold property, plant and equipment to, blah 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 and all. Also they can add up or it may be there or it may not be there also. Sir, what is the use of CRR, sir? Sir, CRR if you have, it can be used only for one and only one purpose only, which is what, sir? To issue bonus shares. I think that also brought in somewhere here. Okay. If CRR can be used only for one purpose, that is to issue bonus shares. Earlier, bonus shares was a separate topic in your group 1 accounting. Now we had accounting and advanced accounting. Now both are merged. So this bonus topic is entirely removed from you. But study material doesn't want to let go of this topic. That's the reason this bonus issue, they attach it to other topic. So in this problem also, they say after buyback, company is issued some bonus shares. So like that, they will bring in. So old Pichacha or Bhuta or Ghost. It is not leaving her back. Okay. So what is the entry for bonus issue is, first, you use what reserve for bonus issue? CRR. First priority for bonus issue, we will always give it for CRR. Then second priority, use security premium. Last priority for free reserve. Because CRR has only one utilization, that is to give a bonus shares. Hence, the first priority, you will always give it to CRR. If CRR does not have, if we don't have CRR, or if CRR does not have enough balance, then the next best option we'll touch upon is securities premium, because security premium has 5 uses, and one of the utilization being to issue bonus shares. Free reserve has no limitation. That's the reason we give last priority to free reserve. And what is the entry for bonus issue? When you issue bonus shares, these free reserve balance will reduce. Or if you wanted logically, what is the journal entry for shares issued 1 lakh? Equity shares issued 1 lakh. What is the journal entry? Don't worry about application, allotment and all. Tell me one entry. Bank account debit to equity share capital 1 lakh, 1 lakh. Correct? Now, sir, bonus shares means, what does the word bonus mean? Bonus shares means additional shares given to existing shareholders at free of cost. Bonus means OC. Okay, South Indian language OC, meaning it is a free. The shareholders don't have to pay anything. It is received absolutely free. Let's say a company issued bonus shares worth 1 lakh. Can they pass the same entry? Yeah? Can they write bank account debit to equity share capital? No. Because the company received money? No. So instead of debiting bank account, we will debit what? Reserve account. So we will basically, what is the entry for bonus issue is reserve account debit to equity share capital account. Like this. So which reserve? First priority to CRR, next priority to SP, last priority to free reserve. So basically the entry is CRR account debit to equity share capital. But the problem is, if today the company declares bonus, let's say there are 1 lakh shareholders, all 1 lakh shareholders will get bonus today only. If today company declares, means in their account entire 1 lakh bonus shares will come today only, or there will be a delay? There will be a delay. Between the bonus declaration date and the bonus receipt date, there will be a delay. Hence, no sir, we don't write the entry reserve to equity share capital. We split it up into 2. Hence, the entry for bonus issue will be, which reserve first you will utilize? CRR. So the entry is CRR account debit. What should have been credited? Equity share capital. Instead of that, we create a dummy called bonus to equity shareholders account, or bonus to shareholders account also you can call it. Okay. So CRR account debit to bonus to equity shareholders. Is this an actual account or dummy? Dummy. So on the date of declaration, you pass this particular journal entry. On the day bonus actually is issued, then you will write bonus to shareholders account debit. What should have been actually credited? Equity share capital account. So if you add these 2 entries, bonus will get credited. Effectively, the entry is reserved to equity share capital. So that's the entry for bonus issue. All this, how much extent and all, the question may, it will be clearly specified, which we will take it up. One question. Great. అర్థమైందా? அடுத்த problem பார்க்கலாமா? Okay, I think conceptually we have done with everything. Now we have generally 2 types of questions they ask. One is for bonus issue ka journal entry they will ask, or maximum amount of buyback you need to calculate and give it. Those are the 2 types of questions that popularly gets asked in this particular chapter. So let's run through this chapter ka some questions. First, some RTP May 2024 question. We'll take it up. Sir, there is a company. They've given a whole lot of information. We don't want all this. So first we want equity shares. What is the face value of each equity shares? 10 rupees. Come back directly to the adjustment. Don't waste your time. Majority of the crux will be in the adjustment. So don't waste your time reading each line of balance sheet. Directly come to the adjustment. Wherever you get stuck, then you can go to the relevant balance sheet section or note section and figure out what the necessary informations are. Okay. On 21st April, first of all, there's the balance sheet, I think, as on 31st March. Few days later, on 21st April, company announced buyback of 15,000 of his equity shares of 15 rupees per share. Hang on, sir. What is the face value of each share? 10. But what is the buyback price? 15. Face value is 10. But buyback price is 15. That means is company paying extra? Yes. How much extra? 5. That only we call it as premium on buy. On one share, the premium element is 5 rupees. Okay. For this purpose, company sold all of its investment for 2.5 lakh. Okay, that's all. Next, on 25th April, company achieved the targeted buyback. Great. On 1st May, the company issued some bonus shares. Bonus will go a little later. First, can we complete the buyback entry? So when did you go for buybacks? First, okay. So what is the journal entry for buyback? Tell me that. Equity share capital account. We'll directly go through it here. Equity share capital account debit. How many shares are you buying back? Entire. We have currently 1 lakh shares. Entire 1 lakh in company buyback, or there is a limit? Sir, should we have to test the limiter, sir? No. Only if they say test whether buyback is within the company's act provision. Like that if they'll ask. Or they will say, tell us how much maximum can the company buy back and pass journal entry for it. Like that they will ask. If they don't ask you the provision or maximum amount of buyback, you don't calculate and waste your time. Some problems may clearly they will ask. Here have they asked anywhere? No, simply they told you are required to pass necessary journal entry for about transaction. That means in these transactions it is assumed that buyback is crossing the limit or within the limit. Within the limit. So you don't have to again calculate the limits and show it. Not required. Fine. So how many shares did they cancel? 15,000 shares. And equity share capital always shown at face value. So cancellation also at face value. So you'll write equity share capital account debit 15,000 into 10, 1,50,000. But is there any premium? Yeah, premium is 5 rupees per share. How many shares are you cancelling? 15,000. So 15,000 into 5 is how much? 75,000. Either you can write premium on buyback, or this premium buyback is anyways a loss. This loss first will be adjusted against what? Securities premium. Check the question. Do we have enough balance in securities premium? Yeah. We have 3 lakh. But premium on buyback is only 75. So entire premium on buyback, we can set it off with the securities premium. So if you want, you can write premium on buyback or directly debit securities premium, your choice. Okay, sir. And to credit will be given to equity shareholders account. No, our study material uses equity share buyback. How much we need to pay? 2,25,000. That is one. Premium we have already transferred to security premium. So that premium entry will not come. Generally we say 4 entries are there with buyback. One is cancellation. Second entry to transfer premium. Third entry to create CRR. Fourth entry is to make the payment. Here first and second entry already we have clubbed and passed. Third entry is for CRR. Did you cancel any capital? Yeah. How much did you debit share capital by? 1,50,000. That means is the share capital value same or it reduced? Reduced. That means is there any gap in capital? Yes. How much gap in capital? Since capital reduced by 150, there is a gap in capital to the extent of 150. Can you keep it idle or you need to fill it up? You need to fill that capital gap. How? By creating CRR. And CRR is always created from free reserve. Free reserve means those reserves which are available for dividend declaration. And generally in all our problems, they will give you only general reserve and P&L. Both are free reserves. But if they say some other reserve, and in bracket may if they say available for dividend declaration, then this other reserve also will become free reserve. Basically any reserve from which you can pay dividend is a free reserve. Here how much CRR we need to create? 150. I told our study material prioritizes which free reserve for CRR creation. First they will utilize general reserve. Do we have any general reserve here? Yes. How much general reserve we have? 2,50,000. How much we need to create CRR for? 1,50,000. What is the entry to create CRR? General reserve balance will reduce. CRR balance will increase. So the entry will be general reserve account debit to CRR account. 1,50,000, 1,50,000. Last will be your payment entry. What is the payment entry? Equity share buyback account debit to bank account. Fine. But to finance this buyback, I think company here also sold some investment, they told. No? For this purpose, they sold all the investment for 2.5 lakh. What is the value of investment in the balance sheet, sir? 2 lakh. You sold it for how much? 2.5 lakh. That means company made profit or loss? Profit. Don't say capital reduction account. This is internal reconstruction. I know we did this topic after internal reconstruction. Left, right, center, don't bring in everywhere. Okay. It happens. It may be a silly matter. Suppose they give this question after internal reconstruction in the question. Our mind will be like every profit, every expense, everything to reconstruction account. So this profit also through reconstruction account. Our mind will say P&L, but our hand will write reconstruction. And our mind ka hand ka thought process invigilator will not give a damn. He will say 0. Silly mistakes can happen because, sir, 100% we are not vigilant. Even in class now. See, we are doing the topic. About more than 150 students are there in online, lively watching that. Every moment, every second, are you listening to me? No. You're actually chatting. So who's doing what chat? Let's check what is happening in Instagram. What happened to our Rocky Boy ka love story? Yeah, we will check 101 things in between also. Because, sir, one of the difficult thing to keep a track of is our mind. They say beyond 15 minutes, if you are able to retain someone's attention, you are God. Literally. Because it is next to impossible, they say. I mean, 100% attention. Very difficult, because suddenly, somebody will be like, this is boring. Somewhere will go off. Yeah, it's always the case. Very difficult. So that all that happens. Same happens in exam also. Though examination is a very serious affair, we want to be as present as possible. But mind to bacha hai ji. It wants to roam around ji. Yeah. So it wants to say, I want to finish the examination and chill out with my girlfriend, boyfriend, or go there, go here, and all that stuff. So it can happen. So these sort of silly mistakes you'll identify only when you write some papers. I can't identify for you. Whatever I feel, I have known or I've seen or I've committed, I can tell with you. But you are creative, you know it. I don't have to tell you. You will commit new things, yeah, which I will tell in the next batch. Now I can't tell, yeah. Okay, for now let's go with this. So what is the journal entry for investment sold? Bank account debit 2,50,000 to investment 2 lakh to profit on sale or to P&L account 50,000. This is the journal entry. Okay, that's all is the drama, sir, or one more is there, sir. That's all is the drama on 25th April. Next, what happened? On 1st May, the company is issued 1 fully paid up shares of 10 each by the way of bonus. Sir, the moment they say bonus shares, is the company is issuing bonus shares for cash or free? Free. Okay, so that means which reserve will be utilized for bonus shares? First, don't blindly use CRR. You can use CRR for bonus issue provided CRR has enough balance. You need to check that. If CRR does not have enough balance, you have to go for security premium. Still, if there is a shortage, you have to go for free risk, like that. So here, how many bonus shares are given? The company will issue 1 fully paid up bonus shares of 10 each for every 8 equity shares. So if you are owning 8 shares already, you will get 1 bonus shares. Not me, question telling. Correct? So when did you go for bonus? 1st May. On 1st May, does company have 1 lakh shares? No, chi. On 25th only, you cancelled 15,000 shares, no? Buying back of shares means cancellation of equity shares. Now means on 1st May, company does not have 1 lakh shares. In this 1,15,000 is already cancelled. So if you have 8, you will get 1. If you have 85,000, how much? If you calculated, I think I've already done. So the number of bonus shares will be 10,625. Sir, this 85,000 is the value of shares or number of shares? Number of shares. So this 10,625 also is the value of bonus shares or number of bonus shares? Number of bonus shares. Each bonus shares ka value they only told in the question, which is 10 each. 10 rupees. 1 share ka worth is 10 rupees. We have 10,625 bonus shares. So total value will be 1,06,250 rupees. That is the value of bonus shares which the company has issued. Go back. How much CRR did you create previously for buyback? 1,50,000. How much you need for bonus issue? 1 second. You need a bonus issue only 106. So do we have enough do we have shortage or we have enough balance? In CRR only we have enough balance. So tell me the journal entry for bonus issue. Let me see. CRR account debit to equity share capital. No. CRR account debit to bonus to equity shareholders account or bonus to shareholders account. Then bonus to shareholders account debit 106,252 equity share capital account. I told 2 entries because there will be a delay. Between the date of declaration of bonus issue and the date of issue of bonus issue, there will be a slight delay. Maybe 1 week delay, 10 days delay, whatever. Because of delay, we pass 2 entries for bonus issue and not just 1. Okay, Saru? Alright. Sir, one more way they can bring it in. Here is some reserve ka limitation they will bring it in. Sir, how much is the balance in general reserve here? Check. How much is the balance in general reserve? 2,50,000. Okay, sometimes what they'll tell in the problem is, I think I've written it down. Suppose they mention in the problem, maintain a balance of 2 lakh in general reserve. Like this also, they'll bring in as extra fitting. This is not there in this problem. This is suppose a scenario. One more way of asking the same question. They will say maintain a minimum balance in general reserve of 2 lakh. Sir, go back to the balance sheet. How much balance is available in general reserve? 250. Sir, after doing buyback, how much you need to maintain? 2 lakh. So you do whatever you want, but balance in general reserve should not come below 2 lakh. That means how much of general reserve can you actually utilize? Though you have 2.5 lakh, entire 2.5 lakh you can utilize or only 50,000? Only 50,000 because they told you have to maintain general reserve balance of 2 lakhs. So can you touch that 2 lakh? No. Only how much you can touch or how much you can utilize? Only 50,000. That means how much can you utilize means general reserve you use this per se for what? For CRR creation. So in this case, you can use general reserve to create CRR only to the extent of 50,000. Is this there in this problem or just a different case? Just a different case discussing. This also could come in the exam. So discuss. Done now? So how much CRR we need to create? 1.5 lakh. Entire 1.5 lakh. Can you pick from general reserve? In this case, no. You can only utilize how much? 50,000. So in this case, the journal entry will be general reserve account debit 50,000. Balance you will pick it from other free reserve. After general reserve, what is other free reserve remaining? P&L. So how much shortage is there? 1 lakh. So we'll use that shortage to the extent of 1 lakh from P&L and create the CRR. There's another way this particular adjustment can come through. Yeah, MTP also it came. Next question is that only. Okay, don't worry. That is what is my next question. Okay, this is the MTP question you're talking about. Yeah, see, I told you about MCQ questions. No, see here, this is an MTP question which has come. They've given 4 MCQ questions. Each carries about 2 marks. So they'll basically give you a case study and ask you 4 MCQ questions. Maybe some may be theory, some may be calculation. I personally feel mostly it will be a calculator based question. Unless they make a consolidation, amalgamation question lengthy. If they make those chapter question really lengthy, these questions they have to ask it as theory, because otherwise student will not be in a position to complete the paper. So they will take that paper ka length into consideration, and accordingly it could be a case study or it could be a straightforward theory or calculation based. Attempt to attempt, it may vary. So don't worry too much about it. Now this is an MCQ question. We have not even solved one MCQ question. We have solved in questions, correct? But these sort of case study have we solved? No. But now you will see this. After reading, I'll ask you the same question. You tell me, do you read extra practice for this? This came in MTP March 2024. Kesar, one company is there. They're giving full stories. They have plans to repurchase 25,000 equity shares of how much each? 10. So what is this 10? Face value at a price of 20 per share. So what is this 20? Buyback price. So 10 rupees worth face value of the share, they are buying it at 20 rupees. So is there any premium? Yes. The premium per share is 10 rupees. Okay. They've given all nonsense story. Resolution we have passed, do this, to that, to and all. We don't have time to listen to their story. You don't have time to listen to my story and all. Will you listen to them? No. So here is a snapshot of Kesar ka balance sheet they have given. Sir, share capital they have given, fully paid up shares of 10 each. 12,50,000. Mind you, this is not number of shares, it is share capital. And they clearly use the word rupees also. Okay. Reserves and surplus. SP is 2.5, P&L is 125, revenue reserve. Revenue reserve means your general reserve, which is 15 lakh. Okay. Long-term borrowings is, we have debentures and we have unsecured loan. 2 debts we have. Then they have given assets ka information. What are they first asking? First, look at the first question. By using share outstanding test, calculate the number of shares bought back. New thing for us, or we know this? We know this. Calculate the number of shares that can be bought back using share outstanding test. What does our share outstanding test say? How much ever shares you have, 25% of the maximum you can buy back. This 12,50,000 is the number of shares or share capital? 12,50,000 is a share capital. Each share ka face value is how much? 10. So divide by 10 you do. How many shares the company has? 1,25,000. 1,25,000 is a number of existing shares. Entire you can cancel or only 25%. So calculate 25% of 125 is how much? 31,250. Select B as Bengaluru, right option. That's all. Over. Don't have to show the working in MCQ question. Most probably in MCQ, they'll be giving you a separate booklet, OMR sheet, where you have to tick, in my opinion. Let's see, even one attempt does not pass. No, I can't say with certainty. That's what I heard, and I believe that's the way to do it. Because most probably MCQs and all will be mostly computerized testing, I think. Manual testing will not happen. So make sure that you circle them properly. Yeah, don't go stingy there. Okay, properly circle and do it. Okay. Next, second MCQ they've given is by using resource test. So 1 second, sir. Resource test, do we know? Yeah. What does resource test ka condition say? 25% of paid up capital plus free reserve plus securities premium. So first find out that. So 25% of, take your calculator, 12.5 lakh plus 2.5 lakh, 15 lakh plus 1.25, 16 lakh 25,000 plus 15, 31 lakh 25,000. Adding all this, you're getting 31 lakh 25,000. Correct, Aji? Yes, sir. Okay. Yes, correct or no? Adding all this 31 lakh 25,000, multiply 25% of that. How much you going to get? 7 lakh 81,250. Sir, they want number of shares, but this 7 lakh 81,250 is a number of shares or value of shares? Value of shares. And each share, how much are you buying back at? 20 rupees. So totally value of buyback that you can do is 781,250, and each share ka buyback price is how much? 20, means how many shares can you buy back? So basically this 25% of share capital, free reserve and SP gives you the value of buyback. To get number of shares of buyback, what do we have to do? Take the value, don't divide by face value. Take the buyback price, because this is the total value of buyback that you're doing. And are you buying back at face value or its actual price? Actual price. So always denominator should be the buyback price, not face value in these cases. So if you do that, you're going to get 39,062.5. Which option has that? This. They've rounded it off. Select the next best option. D for Delhi is the correct option here. What do you think next MCQ question will be? Shares test over, resource test over. Obviously, next one will be debt equity test. You do and find out the number of shares, buyback. But the problem with the debt equity test is debt equity ratio should not exceed 2. But this debt equity ratio should be after buyback. After you do the buyback, debt equity ratio should not exceed 2. Okay, that's what the condition says. Do you know the number of shares bought back? No. That means, can you calculate debt equity ratio? Because the condition is debt equity ratio after buyback should not cross 2. Maximum it can be 2. But do you know the buyback? No, that only we are trying to find out. No. So condition says after buyback. We don't know how many shares we are buying back. How do we do? This is not straightforward. Hence, you have to assume some variables. You can do in simultaneous equation approach X and Y. I feel that is a little complex. The easier method is just assume one variable, and that could be your X. Not your X, just a variable X. So how do we do this problem is, I think anybody remembers. Can you tell me what do we do? Forgotten. Online, I think I'll get a response after 5 seconds. Yeah, there is a delay. Maybe they know, but yeah. Okay, no problem. In the interest of time, I'll only run through. So do we know the value of shares bought back? No. Hence, what we assume is, let the total face value of the shares bought back. Let the total face value of the shares bought back be X. You can assume any variable. I like X. So I will take X. Okay. Let the total face value of the shares, not face value of one share. I've assumed total face value. Let the total face value of the shares bought back be X. That is one. Okay. So now let's bring this number into our equation. What does our equation say? Debt equity ratio should not exceed 2. Meaning debt divided by equity can be a maximum of 2. So equate this equation. Debt divided by equity should be equal to 2. So debt for this purpose includes both short-term debt as well as long-term debt. Short-term as well as long-term. Here short-term they have not given, so add these two. These are the debts they have given. Both are long-term here. Short-term is not given. If at all short-term is given, add that also. In some of the problems we have seen that. So add these two, sir. How much are you getting? So it is what, sir? 40, 30, 44, 45.25. Huh? Yeah, adding these two, you're going to get 45,25,000. That is your numerator, which is debt divided by equity. One second. Sir, this debt by equity is before buyback or after buyback? After buyback. Keep that in mind. So do you think, what are you buying back? Equity shares. Are you cancelling debt? No. That means will there, due to buyback, will there be any changes in debt or same data? Whatever debt you had before buyback, same debt you will have after buyback also. So numerator will not change. Whatever is given, debt value given in balance sheet or question, take the same data. However, denominator is equity. Equity here refers to this one, sir. Equity here refers to paid up share capital plus free reserve plus securities premium. Should we have to calculate this or already done? For resource test, we already did that, no? And we got how much? 31,25,000. Yes, sir. Again, no need to add up. Equity here refers to equity share capital plus free reserves and securities premium. We have already added here and got how much? 31,25,000. So take that in the denominator. Yes, sir. Minus 3x you have to do. Sir, what is this 3x, sir? 1, sir. After you buy back, equity share capital will be same or it will reduce? It will reduce. Equity share capital always shown at face value. So when you do buyback, it will also reduce by face value. How much is the face value of the shares I've assumed? X. Not face value of one share. So I've assumed total face value of the shares bought back to be X. So that means this is only your equity share capital. And I've assumed this to be what, sir? X. Correct? No. So if you do the buyback, will equity share capital be same or it will reduce? It will reduce. It will reduce by 1x. This 1x reduction is for equity share capital. Correct? Because after you buy back, equity share capital will reduce. That reduction only I've assumed it as X. That is one. Okay, sir. Sir, the moment you do buyback of equity shares, Companies Act will come throwing at you. For what? If you do buyback of equity shares, capital will reduce. So capital gap will be there. Can we keep that gap as it is, or we need to fill up that gap? We need to fill up that gap. How do you fill up that gap? By creating CRR. Sir, you will create CRR for buyback price or only capital gap? Capital gap, and capital is always shown at face value. How much face value of the shares you cancel? X. That means how much gap will be created to the extent of X. Like suppose you are cancelling equity shares worth 1 lakh. You will create CRR also to the extent of 1 lakh, like that. So if your equity share capital, if you are cancelling to the extent of X, your CRR also you need to create for X. So why did you reduce, sir? CRR you will create from what? You will create CRR from free reserve. When you create CRR, free reserve balance will be same or it will reduce? Reduce. This 31,25,000 includes free reserve also, no? After buyback, will free reserve balance be same or it will reduce? Reduce by what amount? X amount only. Hence, one more reduction. This is for general reserve or P&L reduction due to CRR creation. Why not? Sir, if you are issuing new shares, sir, have they told in the problem anywhere they issued new shares, sir? No. That means what? Okay. If you do buyback, capital gap will be there for full buyback. So you have to create CRR also for full buyback because no new equity shares are issued. That's the reason if you have cancelled equity share capital for X means CRR also you need to create for X. So correct, sir. So capital cancellation accounted, CRR accounted. One more you account. Whenever in confusion, go back to your 4 journal entry, basic journal entries for buyback. What is that? One is capital cancellation accounted. Yes. Another one is you have premium. What do you do for premium? Transfer it to securities premium. Accounted or not yet accounted? Not yet accounted. One more is CRR creation. Accounted CRR? Yes. Another one is bank entry. Will bank affect debt or equity? No. So ignore that. So 2 things we already accounted. Capital cancellation, CRR creation. One more impact we have not given, which is securities premium. Because if you buy the shares at premium, security premium, that loss only we call it as premium on buyback. That premium on buyback, you don't transfer it to P&L. We set it off with securities premium first. Okay, now look at this, sir. What is the buyback price in this problem? 20. What is the face value of the share? They only given here. Face value of each share is given to be how much, sir? 10. Sir, buyback price is 20. Face value is 10. That means what is the premium? 10. You're buying, face value of the share is 10, and if you're buying back at 20 means how much extra you're giving? 10 only, no? Now have a quick look. These two are different or same? Face value and premium here different or same? Same. Sir, this only I've assumed it as X. That means premium also will be X because both these two are different or same? Same. That's the reason if you are buying back to the extent of X means premium also will be there to the extent of X. And due to this premium, security premium balance will be same or it will reduce? Reduce. That means one more minus you have to do as minus X. Why minus? Because security premium balance will reduce. That's the reason minus X. This minus X is for security premium ka reduction. These are the 3 X's in this question. Okay, G. Solve the equation, G. That's all. Minus 3X if you do. If you solve the equation, you're going to get X to be 2,87,500. Okay, sir? Any doubts, sir? No, sir. Sir, this 2,87,500 is a number of shares or value of shares? Value of shares. Sir, this 2,87,500 you take, sir. Divide by buyback price you do, sir. You will get number of shares, sir. I will throw everything at you, sir. Yeah. Why, sir? Sir, X is what, sir? Don't divide 2,87,500 by buyback price. Divided by 10. Sir, partiality, sir. There you divided by 20. Here you are dividing by 10. Die. Not like that, pa. What is this X? What is this X? X is the total value or total face value. X, what did we assume? We assumed as what, sir? X is the total face value of equity shares bought back. And total face value of equity shares bought back is 2,87,500. And face value of one share is 20 or only 10 now? Total face value of the share bought back is 2,87,500 and the face value of one share bought back is 10. So how many shares maximum you can buy back? 2,87,500 divided by 10 you have to do, not 20. Understood or not? Partiality based on the assumptions or what we have assumed accordingly we need to do. Yes, sir. So how much are you getting, sir? 287,500. That is what we said over here. Okay. All right. So this is the thing about buyback. So how many shares did you get it over here? 28,750. Which option has 28,750? Chennai has this. Okay. All right. Chennai always has the right option. Huh? Okay. Beat in terms of team or beat in terms of IPL trophy. Looks like they're never going wrong, you know. Talai, I tell you, he's in a different league only, whether he plays or not. But ultimately, when he walks in that full, I think I saw that video there where he walks in that full Talaivar music, you know. I don't know that music. Yeah, I think it was Padayappa music or something they played, I think. Yeah, memes. Craze is on a different level. Now can we get to this craze? Yeah. What do you think will be the fourth question? So, how many maximum shares can you buy back? Check on the basis of all the three tests, maximum number of shares company can buy back. What does the Companies Act say? Test all the three limits. Take the highest or take the lowest. First option gave you 31 to 50. Second one gave you 39. Third one gave you 28. What is the lowest? 28. So that means you select a C for again, Chennai 28, 750. Okay. So new thing or same thing? Same thing. This is how probably you'll get an MCQ question. So is this around a new concept or something which you have learned? So I feel they're going to revolve the MCQs like this. So you don't have to freak out too much about the MCQ questions. Now can I get to the other one? Just for my confidence, I thought I will create another question or question I didn't create. Question is already there. We'll solve one more question on this debt equity ratio. Just for I know you have got it, you know. Just me, I want to practice once more for myself. That's all. Okay, can we take one more question for my satisfaction? Okay. Sir, Pratham Limited is a study material question. Has the following capital structure. Their face value is how much? 10. General reserve is it a free reserve, sir? Yes. Is security premium free reserve? No. Is P&L a free reserve? Yes. Sir, is the revaluation reserve a free reserve? Oh, no. So if they give you revaluation reserve and all, don't bring it into debt equity testing. Okay. Loan funds. Loan fund is your debt, which is given as 42 lakh. You are required to compute by debt equity test only. Not everything. Only debt equity test. Maximum number of shares that can be bought back. And buyback price here, they've assumed it to be 30. Last problem 20. This problem 30. But face value is 10 only. So can we quickly run through this? So what does our debt equity test say? Debt divided by equity should not exceed 2. Meaning maximum it can be is 2. We are trying to find out maximum buyback only. So we'll do debt divided by equity and we'll equate it with what, sir? 2. So due to buyback, will debt change or same? Same. How much is the value of debt? 42 lakh. Bring it in the numerator. Okay. Divided by equity in the denominator. Sir, what is equity for debt equity ratio purpose? Take equity share, capital. Add free reserve. Free reserve means general reserve and P&L. Sorry, are these two only free reserve? No. Any other reserve if it is there. And if it is available for dividend declaration, that also can become free reserve. But usually in the problem, they'll only specify general reserve and P&L. Okay. This is your free reserve. That's all. One more. One more is your securities premium. So take your calculator. Do 30 lakh is your equity share capital. Add this. Plus 32.5, which is 62.5. Plus 6. So 68.5. Plus 4.5. 68.5 is 68.8. 72.8. 73. 72.8. Okay, no problem. Whatever number you're getting. Or maybe we look at this only. It's okay. So I added all this. Okay, now sir. I've added all these. Now, can I take that number or this equity should be after buyback? This equity should be after buyback. After buyback, will equity share capital be same? No. Hence, what do we assume? First, what is the assumption we'll write? Let the face value or total face value. Let total face value of the equity shares bought back be X. Share capital is always shown at face value. And I'm telling let the face value of equity shares bought back also be X. So what we have to do first? Minus X we have to do. Why we have to do minus X first? Because after buyback, equity share capital will not be same, it will reduce. That reduced number only, I'm assuming it as X. So one reduction of X is for share capital reduction. Next one is what, sir? The moment share capital reduce, capital gap got created. Can we keep the gap pending or create CRR? Create CRR. We create CRR for only capital gap and capital always shown at face value. So if capital got reduced by X means CRR you will create it for X. And CRR you created from what reserve? Free reserve. So that is usually general reserve or P&L. Study material first I told utilizes general reserve. So the moment you create CRR, general reserve balance will reduce. So another minus for that. Okay, that's all. No. What is the face value of the share? 10. But did you buy it at 10 or you bought it at 30? Buyback price is 30. 10 worth of share you are buying it at 30 means the premium element is how much? 20 is the premium, correct? Now compare, sir, only this. Face value is 10 means premium will be 20. Face value is 10 means premium will be 20. That means premium is equal to face value like last problem or double? This is 10 means this is 20. So double. Face value of the shares I've assumed it as X. That means the premium will be X in this problem or twice. That means the premium in this problem will be 2X. And due to premium on buyback, security premium balance will be same or it will reduce. That means again we have to do minus 2X. That will be for security premium reduction. So you have to solve this equation. Once you solve the equation, you're going to get 12,95,000 as the X ka value. What is this X? Total buyback or total face value of buyback? I've assumed X as total face value. So total face value of the shares bought back is 12,95,000. Will I divide by 30 the buyback price? No. This is the not total value. It is the total face value. And face value of one share is 10. So how many shares can you buy back? 12,95,000 divided by 10, which will be 1,29,500. Yes. Yeah. All right. Yeah. CRR is not included in this equation. Equity for this purpose, CRR is not created. Correct. Fine. See, CRR we cannot include in this equation. Someone is saying, sir, though general reserve reduced due to CRR, CRR got created. No. So that means why can't be that? This equity for this purpose includes only, I didn't frame this rule. This rule is framed by Companies Act. Equity, when we say equity here, it refers to only equity share capital, free reserves and securities premium, nothing else. If you just check, we had revaluation reserve also. Did we consider that? No. Only these has to be considered. Nothing else other than that. Like that. Okay, Saru? That's all is this particular problem. So with this, this chapter is also we have completed.